Hello, everybody. Good evening. Uh, so we will have a pretty interesting session today on equalization levy. I'll tell you why it's interesting. Pretty easy, pretty straightforward, but of course it has opened up a lot of controversy and something which the entire world is looking at. If you remember, normally income tax is a country specific, but this is one particular aspect which I would say is being closely watched, and this is coming into international taxation. Till now, taxation, domestic taxation always had some sort of a politics. When I mean it's just domestic politics, trying to appease the mass by reducing the threshold slabs, exempting agriculture. But then we are talking about international taxation, so geopolitics. So that is what equalization levy has done. So we will discuss about equalization levy, how and something which the younger generation, your generation can very much. But before I move on, last uh, three sessions we had on transfer pricing, in terms of how transfer pricing works, what are the methods to compute arm's length pricing. So we saw the funda at the end of the day is very simple. All I have to ensure that my transaction with my closely related enterprise should be at arm's length. How do I check my arm's length? I have to benchmark, compare with a similar party, and they've given the income tax. Yeah, yeah, I will zoom in. I have not started yet. I will zoom. So all you have to need to, then there are 5, 6 methods prescribed under the income tax, and we saw all those methods. And what we did in the last session is we did few MCQs as a recap for the previous session. So today, before I go on with the new chapter on equalization levy, we covered certain other aspects in the last session, like secondary adjustment, APA. So what we will do is we'll complete the transfer pricing cycle. We'll look at the balanced set of MCQs which I've compiled here. So let's start with it. And just like the last session where I had got very good participation, where you all guys chipped in with your answers, I would really appreciate if you can continue to do that today as well. Basically, just a recap of the last sessions on transfer pricing, the one which we did on Tuesday, which we did on Thursday, in terms of the primary adjustment, the secondary adjustment, so on and so forth. So starting off with question 11. So this is with regards to, if you recollect, the range we are talking. So as you would have seen in the last three sessions, very little of technical provisions. This is very unique to income tax, because all you would have so far seen is this section, that section, and this section talk. Notwithstanding, go to this. But transfer pricing, it's all driven to one section, and it is more procedurally driven. And we saw at the end of the day, a lot of things is trying to get your math right. And we also saw how important statistics is. One aspect on statistics we looked into is the computation of range, in terms of where you need, if you have multiple arm's length prices, in that case, you have to go on a range to find out whether your transfer price falls within that range. But one of the criteria, if you recollect, so that is the question number 11 in front of you, where there are more than one arm's length price to be determined from comparable companies, the data set of comparable companies should be at least. So please mention which of the answers. Of course, we will come back and discuss. Meanwhile, I would want you to chip in with your answers as well. I've already got an answer, so I would appreciate all others participating as well. So 12th, we already completed last session. Whether section 10AA exemption or chapter 6A is eligible. The answer is no, not available, because these are anti-avoidance provisions. So there's no question of claiming 10AA exemption or chapter 6A. Now, we move on to 13th. This is something we discussed last session on secondary adjustment. If you recollect the secondary adjustment, the primary adjustment is the initial adjustment which the transfer pricing officer will undertake based on benchmarking and based on arm's length pricing. And then we looked into the secondary adjustment. So under secondary adjustment, whatever primary adjustment is then, that money, it's basically trying to close the loop. That money has to be brought back to India. What is the point in just paying tax? They also want the money, not they don't want to just to remain a very mere tax exercise. They also want that money back into India because that money has gone out of India. So keeping in mind the forex as well. And secondary adjustment is a global practice. So within how many days uh, should it be brought in? All right. So 13th. So within which should the associate enterprise or the Indian company with where primary adjustment has done under the secondary adjustment provision 92 CE, within how many days should the money be repatriated back into India? 30, 45, 60, 90 days. So you can shoot your answer. The next is, so this some mishap with the number. Anyway, next is question number 14. India follows which of the following approach in relation to secondary adjustment? So we discussed this. If you don't bring back the money, that money will be treated as dash. That's precisely. And then accordingly, we found out, an interest has to be. So whether does India follow a deemed equity approach, deemed dividends approach, deemed loan approach, or deemed associated enterprise approach. So obviously the D looks bizarre, so it can only be A, B, and C. So I want you to key in which one would be your answer with regards to question number 14. Which approach does India follow? Because there are some countries which follow different approach to India. Of course, when we discuss the answer, we discussed this in the last session as well. Anyway, I'll reiterate again. So I want you to answer which method does India follow with regards to question number 14 when it comes to secondary adjustment, when the money has to be repatriated back into India. And if the money is not repatriated back in India, how does India treat it? Let's move on to question number 15. We discussed this as well. An assessee has failed to furnish report under section 92E of the Income Tax Act. What is the penalty prescribed under section 271 BA for such a failure? I know this is a procedural question, but then you can expect these kind of questions in the MCQs. Good to see answers chipping in. So furnished report under section 92E is basically chartered accountant certificate, form 3CEB, professional opportunity for us or chartered accountant to certify to ensure that the transfer pricing is at arm's length, the taxpayer and its associated enterprise have maintained adequate documentation, so on and so forth. The income tax wants a certificate form 3CEB from a chartered accountant, and if that is not furnished, what is the penalty? Whether it's 1 lakh, whether it's 10 lakhs, 1%, 2%, 271 BA. Now, with regards to question number 16, any agreement entered between the taxpayer and the CBDT which determines the arm's length price of future intercompany transactions. So this is a giveaway, future intercompany transactions. So we are talking about future transactions, agreement entered between taxpayer and CBDT. Remember, we discussed about dispute prevention mechanism. So this is one of the dispute prevention mechanism. What is it called? Is it advanced pricing agreement? Is it transfer pricing tax agreement, arm's length pricing agreement, profit shifting agreement? So I want you to answer which of these will come for question number 16. Any agreement entered between the taxpayer and the CBDT for future intercompany. So we are talking about future. So that's why it's called dispute prevention. So we are trying to prevent, and income tax has couple of, especially for transfer pricing, introduced two dispute prevention mechanism. One is a safe harbor, another is this one. Which one is this? So 16th, I want you to answer. 17th, this is one of the unique feature of the advanced pricing arrangement or advanced pricing agreement. An assessee can roll back under the APA for how many years? So we have a rollback provision, which means the agreement entered between the taxpayer and the tax administration can also be rolled back, meaning that can be used for years which has gone by retroactively. I'm sure you know the difference between retroactive and retrospective. Retrospective is bringing something into vogue. I retrospectively amend from 1962 from the Act, but then it will applicable uh, from this date, and retroactively is giving effect. That is even assuming if I bring the provision in 2015 from 1962, then I from 2015 from now onwards it will start applying. So it's called retroactive. Basically, you're trying to go back and trying to do something which ideally you cannot do, but then retroactive is basically India did a lot of retroactive provisions. If you remember, Section 9 was retroactive. Similarly, under this, you can roll back and ensure that the advanced pricing arrangement is valid for the past years as well. So, till how many years can you roll back for closed years or years that has gone by? That is the question here, whether 2 years, 3 years, 4 years, or 5 years. Let's move to question number 18. Question number 18 is again a very procedural question. If you recollect, we discussed about safe harbor provision, which is also a dispute prevention mechanism. As I mentioned, if you recollect, under safe harbor rules, which is a dispute prevention, basically computing the margins is a difficult task. So therefore, what the government did is, I'll give you a menu card. The menu card will tell you what is the margin, what is the arm's length rate it should be. And if you're able to satisfy in the menu card, I'm not going to bother you with any of the transfer pricing adjustments. So safe harbor is eligible for not all the transactions. There are certain transactions, there are certain thresholds also specified. This is one question relating to threshold. That is information technology enabled service, ITES, which India is very famous for. So when assessee provides ITES to its associate enterprise, there is a threshold given, that is the turnover. So not for all ITES, but that is ITES there, but there is a threshold up to certain turnover. Assessee does it with associate enterprise. This is a turnover threshold. Safe harbor can be invoked. So what is that? Whether it's 50 crores, 100 crores, 200 crores, or 400 crores. So for example, an assessee is doing ITES service for its associate enterprise, and the transaction turnover is up to, say, 100 crores, if that is specified, then only till 100 crores, only those companies eligible. If you're a big company, basically they don't want to give safe harbor for larger organization. So therefore, they are stopping the threshold. So what is the threshold on the maximum value? Look at the threshold on the maximum value. Don't worry if you don't know the answer, but you can always look at it, refer it, but just give it a shot. We'll discuss any case. Section 9. If you personally ask me, if given an option, I will not ask a question like 18, but I have seen in the past there have been such questions that is asked. This is more trying to test your memory. But anyway, that's how the nature of the game is. We need to play it. Question number 19. Section 94B, thin capitalization, if you recollect. So thin capitalization is where a company, what they do is, when they set up operations in India, they'll set up with a minimal capital of just 1 lakh. And then they'll pump in balance with heavy amount of loan in the form of ECB, debentures, and thereby they claim interest. The Indian company will claim interest, so the tax will get reduced. So this is kind of a base erosion happening. For that, thin capitalization rules was introduced, wherein up to 30% of your EBITDA is the maximum interest you can claim. So a company paying interest, the maximum interest that it can pay is up to 30% of EBITDA. Anything above that will be disallowed under section 94B. So this is called thin capitalization. Companies which are thinly capitalized. So it's a global terminology, thin capitalization. Otherwise, your debt equity. Normally, people don't come into equity because you won't get any deduction in equity. So they try to play around using debt instrument, thereby reduce the taxes. So 94B was introduced. But 94B is giving exemption to one particular business. So 94B, you just have to use your common sense here. Which of these business is excluded? we're talking about interest. So there is one particular sector of business has been excluded. Very simple. All you need to do is, again, your common sense 94p. Logically, what do you, which industry will be carved out? Seeing the nature of the industry, you can figure it out. Question number 20. As per section 94b, what is so 94b also has a threshold. So it says not all interest transactions. So if you make interest payment up to certain amount, we are not going to bother you. If it exceeds that amount, 94b will kick in, just like your exemption limit. So there is an exemption limit available for 94b as well. That is what I've tried to check in. Question number 20. As per section 94b, what is the threshold applicability with regards to expenditure made by way of interest to trigger the provisions of 94b? So whether it's 4 crores, 3 crores, 2 crores, or 1 crore. So if it, whatever is the right answer, that if the interest payment exceeds that amount, 94b will clock in. Again, very simple. If you don't know the answer, just use your common sense. If put yourself on the income tax department shoe. If you are the income tax officer, what will be the threshold you will give? The last question. This is also with regards to thin capitalization. So as I mentioned to you, up to 30% of EBITDA will be allowed as deduction. Anything above 30% will be disallowed. So for example, if my EBITDA is 100, my interest expenses can be only up to 30. If it goes to say 40, then the balance 10 will be disallowed. But however, what the tax authorities are saying is, I will give you this 10 rupees to carry forward it for the next years, and you can claim it as a deduction. But again, even the next year, the 30% limit will be applicable. But this amount, the 10 rupees will not get completely extinguished. You have an option to carry forward it, and they're specified for how many years you can carry forward it. 4 years, 5 years, 7 years, and 8 years. So for how many, for how long can you carry forward section 94b interest? Whether it's for 4 years, whether it's for 5 years, whether it's for 7 years, or whether it is for 8 years. So let's discuss the answer now. I'm just looking at the answers, what you have done. All right. Thank you for all those who have participated. All right, so let's quickly run through the answers. With regards to question number 11, when there are more than one ALP determined from comparable companies, so you should have a minimum comparable set of 6 comparable companies in order to get the range. So answer for 11 will be B. Yes, I see some right answers. 12 we already done. 13th, the time limit to bring back the money, the primary adjustment money into India is 90 days. If you don't bring back, then interest will tick in at SBI rate, which is marginal cost of lending rate SBI plus 325 basis point. So currently it's 8% plus 3.25 works out to 11.25%. 14th, India follows which of the following approach? We follow a deemed loan approach because I already gave the answer in my previous listing. So we treat it as an advance. We treat it as a loan. Some countries like South Africa treat as dividend. Some countries treat it largely as an equity capital and then try to put an interest on the capital. But anyway, India goes on a loan approach. India treats it as advance. 15th, the amount is 1 lakh for failure to furnish Form 3CB. 16th, straightforward, pretty simple. It's called Advanced Pricing Agreement, APA. So 17th, under APA, you can roll back. You can go back and use the APA agreed margin for a period of 4 years. So you can go back only up to period of 4 years. Safe harbor rules for ITES is 200 crores. So this is For assessment year 21-22, safe harbor provisions have not been notified. It has been notified till assessment year 2021. So please keep watching out for the amendment once it comes. There might be possibility that the safe harbor existing rules may undergo change because of COVID. So they may try to come out with a reason, less margin, probably increase the turnover, something. So keep watching out the institute website for the Board of Studies release with regards to new safe harbor whenever it gets notified for assessment year 21-22. But till 2021 for ITES up to 200 crores. With regards to question number 19, 94B, this is not available for banking and insurance business because they deal with a lot of interest. So they are completely carved out from 94B. With regards to question 20, the threshold is 1 crore. The minimum threshold. That's why I said put yourself in the shoes of the income tax officer. So up to 1 crore interest you pay to your associated enterprise, 94B won't tick in. But if you pay more than 1 crore, 94B will take in, and you have to ensure that your interest payment is up to 30% of the EBITDA. If it is more than 30% of EBITDA, the balance will be disallowed. The disallowed portion can be carried forward for a period up to 8 years. So you can keep carrying forward up to 8 years, and you can keep setting it off in the subsequent years. But every year you should ensure that it is in the 30% range. So this is the benefit available, slight benefit given to 94B disallowance. All right. So with this, I think we will move on to today's session. Meanwhile, if there are any questions that you feel on transfer pricing, please feel free to shoot. I'll be happy to take it up either today or the next session. All right. So what we are going to do today is look at equalization levy. Now let me, I'll set the tone. I don't know how many of you have watched this documentary in Netflix. I'm sure many of you would have heard about this, created sensation. So if you have watched it, rewatch it again. If you have not watched it, please watch it. It's a very good documentary. But why I'm asking you to watch, of course, there are some very interesting revelations, messages, and how social media has influenced people. But then also there is from a tax perspective, you can find out certain hints as to how these new age technology companies have played a very significant role, which has triggered the BEPS, which we have discussed in the last few days about the significance of BEPS. So these digital media, the new age digital companies have a large role to play with regards to BEPS. The so-called GAFAs, Google, Amazon, Facebook, Apple, they've been at least alleged, it's not alleged, which is a fact as well, for a lot of tax planning. They call it tax planning. The tax authorities call it tax evasion, thereby paying very little tax, leading to BEPS. Not only that, it also brought in huge amount of politics into international taxation. So this is an ideal way to set the tone. So next time, if you not watched, do try to watch it, or if you re-watch it and keep the tax in the back of the mind. We'll be discussing it. Now, I've already said, I've given a hint, or rather I started out saying this, the digital companies are responsible for equalization levy, not necessarily equalization levy, the BEPS, the base erosion profit shifting, because a lot of countries felt because of these digital companies, taxes have been profit have been shifted, base erosion is happening. So companies are not paying, the multinationals are not paying their fair share of taxes. Thereby, eventually what is happening is countries are suffocating from revenues, because what is the major revenue for countries? One of the major revenues is taxation. You cannot keep printing currencies. Keep printing currencies will become like what's happened in Zimbabwe. Inflation, deflation, stagflation, everything will come into it, will create a mockery. So therefore, tax revenues are very important, especially for developing countries and low developing to meet their developmental goals like eradicating poverty, food, infrastructure, so on and so forth. So therefore, is a very significant factor. And in 2009, when the global subprime crisis happened, huge financial recession happened in 2009. Countries came together, and see, even though the financial crisis happened for a different reason, because the subprime crisis, Lehman Brothers collapse, but then one of the reasons they took that as a probably as a a reason. They felt that many of the companies are not paying their fair share of taxes, because of which we are facing huge deficit in tax revenues or tax collections. The tax gap is widening. What do you mean by tax gap? The collection of taxes is very minimal. So what countries did is they said, okay, let's try to solve it. Let's create a action plan called base erosion profit shifting, and try to find out where and all are these multinational enterprises dodging taxes or evading taxes, and let's try to plug all these loopholes. Let's try to play a plumber role and keep plugging all these loopholes to ensure that they don't anymore avoid taxes or dodge taxes. So one of the fallouts of BEPS is the first action, which is the digital economy. Now that led for equalization levy. I'll give you a very, very basic example, or this is a real situation. Prior to equalization levy was introduced, what was happening, and why equalization levy was required. I hope my screen is, my screen is visible. I'm going to show you something. Sometimes these are the advantages of technology classes. Using technology. Look at this website. I have no association with this website, by the way. There's a very interesting Kolkata tribunal judgment in 2009, which actually will give you a very good example on how this equalization. So you understand this. This will give a foundation for equalization levy. This website, Right Florist, the case is also called Right Florist. You can Google it and you'll get the case. Right Florist, in 2009, I still remember early stages of my career. So the Right Florist at that point of time was where if I have to, the website says you can, as you can rightly see, you can give flowers and gift. So if I have my brother or my sister in, say I'm in Chennai, if I have my brother and sister in Delhi, I can just go online. This is in 2008-9. Now it's just very common, and we are all so used to it. At least in all the gadgets that is around us. I think many of us would have only got it from e-commerce, but we're talking about the a decade back. So what you can do through the rightflorist.com website is you can go to this website and you can order my brother's birthday flower, and then he's working in, say, Bangalore. I'll give him address, so they will go and give the bouquet on my behalf. It will reach to him in Bangalore. I am in Chennai. So now what happened in at that point was obviously Right Florist, early stages, at that point, and they need to promote. So what they did was Yahoo. So Yahoo is a search engine like Google. We all use Google. So at that point in time, Yahoo was very popular. So what they did was they made a payment to Yahoo in US. So Yahoo never had any operations in India. So they made an online payment to Yahoo US and said, if anybody searches about flower, bouquet, delivering gifts, please show up my advertisement. So there are some algorithm that work, which is what now Google is a monopoly in it. So at that point in time, Yahoo was equally very good. So Google was still in its early stages. So what Right Florist did is made a payment, engaged Yahoo US and said, please advertise my website, so that when anybody is searching for it, I want, or you find youngsters accessing, please try to put my website so that delivery of flowers, bouquet, so that will help me. So this is purely nothing but advertisement in a digital. What ideally I would have done is, normally what you open the newspaper, you see these advertisements coming in, you see banners advertising, you see in the TV, visual medium, they advertise. So here, since in the digital era coming in, because WW started in late 1990s, so we have obviously post Y2K era, the digital evolution we were in. So what Right For Us did is engage Yahoo and made some payments to Yahoo USA for this advertisement charges. You can call it online advertisement or digital advertisement, because this advertisement, they want it obviously online. It will not come in any print medium or in visual medium, in TV or anything else, or flyer as a newspaper. Now, when Right Florist makes this payment to Yahoo US, when Right Florist makes this payment to Yahoo US, should they have to withhold taxes? Is the question. Because Right Florist is an Indian business. Now they're making a payment to Yahoo US. Right Florist, it is an Indian company, India, making payment to Yahoo USA for online advertisement. Now, what is your view? So let's take for easy, the payment is 1 lakh. The payment. So Right Florist has to make payment to 1 lakh advertisement. Now, what is the TDS? Whether TDS is applicable? If yes, what is the rate? So first, we'll try to understand what is the character of this payment. Whether is it a business income? Whether is it a royalty? Whether it is a fees for technical services. So ideally, this is how we will approach. So this will come under section 195, withholding of taxes. So any payment made by any person to a non-resident. So this is a non-resident, no doubt about it. So now what? 10% TDS, Sandeep says. 10% as I'm assuming fees for technical services. So let's analyze it. You can keep throwing your answers as well. What would you have advised, Right Florist, for making what because we have to now do this 15 CACB. So what would you have done to give the 15 CACB if you are doing your articleship? So many of you are, and this Right Florist approaches you. What would you have been given in order to process this payment? So let's first look at royalty. Now, Yahoo is a website, and in the website you will get the ad, right? Let's also let's make it more practical. Again, that's the advantage. Sandeep says FTS. I'll go to Google. I want to show you this. So let me go to a website. Say, let's assume I want to see cricket scores. Now, when I'm looking at the cricket scores, I don't know. Look, I'm sure many of you can see this ad. Now, of course, I was just I did this before our class to show this. So I was just trying to go to agio.com and see some sneakers for me. Now, which one should I buy? I was just looking at it. I switched it off. Now, obviously, what Google has done is it has seen my what is there I'm searching for. So now it's trying to induce me, showing me. So this is an advertisement by Agio. So similarly here, you will have, when you go to Yahoo, when you go to the website and do something, you will have Right Florist advertisement coming here. So I can click, and then this will take me to the site. Now, if you see here, when I clicked it, look at this here, Rubicon project. So algorithm which is taking me so an ad placed. So this is of course these are all technical stuff. Let's not get into it. But all I want to say is, so this is what Yahoo was doing, and now Google is a monopoly, is a market leader in this. So now coming back, is this a royalty? Is a question. Can Yahoo says, this is a right to use? No, this is cannot be a royalty, because what can be a royalty? Section 916 defines what a royalty is. 917 and of course that is FTS. So royalty is right to use or a copyright trademark. So he's not giving me any right to use. It is he's giving me a space. I'm just using it. It is like I go and take a billboard above a flyover or in the airport, just like that. So can I say that is it right now? I have a right to use. It is a right to use. Normally, royalty is associated when you try to take their copyright and you try to exploit it. I buy a movie, I see a good Hindi movie, and then I want to remake it in Tamil. So I get the rights, and that's why I pay a royalty to it. So you try to exploit it and use it. So this is just mere use of space. So therefore, royalty in my view is not applicable. It cannot be a royalty. That is, right florist, Yahoo cannot say I'm charging royalty to right florist. No, and the Kolkata tribunal also said yes, this cannot be a royalty. How can this be a royalty? This is just putting ad. They have a space. They're just putting in it. Okay, royalty is ruled out. Will this be a fees for technical services? Can I say Yahoo is giving me a technical service? We saw in the Google the ad now. Google does something through their AdSense or AdWords program or some algorithm through a provider. Actually, there are a lot of these online ad agencies who does a lot of these algorithm matchings. They try to design your ad and then they ensure that accordingly how people search, your ad throws up, so on and so forth. So can I say this is a technical services then? So accordingly, as Sandeep Juneja has mentioned it, 115A will come where royalty rates. So 115A read with section 195. TDS has to be deducted at 10%. I'm not going into treaty now because treaty also India, USA 10%. So whether 115A will come. Now we all know Supreme Court and there are various High Court judgments where for FTS one of the primary condition is human intervention. There has to be a human intervention. Sky Cell judgment. These are not mere facility or access. So, but here when Google does algorithm or Yahoo does algorithm, there are no human intervention. These are algorithm, AI, machine learning, whatever you call it. There is no human intervention. Everything has to happen in a quick. That's how it works. So you can again, if you're interested, you can Google it how this ad algorithm works. There are some very interesting videos, and especially as transfer pricing or tax advisors, we need to understand how these businesses works also. So I had a client who explained to me how all these work, especially they were online ad agencies and how companies have to bid. And you could also get some inputs. If you have seen Social Dilemma, you can relate these things as well. So we have various precedents. There has to be a human intervention. So Kolkata Tribunal said no FTS, relying on all these Supreme Court judgment, High Court judgment. This cannot be FTS. There has to be human intervention, no human intervention. So no FTS. So this is not FTS. Then is it a last categorization is business income? Is it a business income? Now Yahoo is a USA company. Yahoo USA. Now if you recollect, when can a India for US company have a tax nexus in India? It has to have a permanent establishment. We discussed the PE concept in transfer pricing. So there has to be an establishment in India which is doing the business. So Yahoo USA should have a branch office in India, which goes and meets people and all those things. Whether does it have a PE? Yahoo said, I don't have any PE, no PE. I do not have any PE. I don't have any office in India. I am based out of Silicon Valley, Yahoo, USA, California, and then everything is done digitally online. Right florist will also pay my charges through PayPal or any payment gateway. And then I will through Yahoo USA. So that's how they make the payment. That's it. And then and then they give me their website. I will give a link to it. Nothing happens. There is no need for Yahoo to have an office in India. So therefore, this is what. So the Kolkata tribunal said business income, no, not taxable. No PE for Yahoo USA. The foreign company should have some nexus, economic nexus. This is a very important word. There has to be a nexus, connection. What is nexus? What is your kind of why tomorrow you have to pay tax? What is your nexus? Your nexus is you are a tax resident. So the nexus is created through residency or through source. So there has to be a source or a nexus connecting factor. So in this case, Yahoo says, I don't even, so remember what is PE? Doing business in India. So Yahoo says, I'm not doing business in India. I'm only doing business with India. So this is a transaction with right florist. So this is a business with India. I'm not doing any business in India. So therefore, I don't have any PE. And Kolkata tribunal said, no PE, no business income, no royalty also, no FTS. Therefore, not taxable. So therefore, this is a classic case of how businesses have evolved. Today, in fact, Netflix, if you remember last week we discussed, until 2018, they never had any operations in India. They might have had maybe some software or even now, but then they didn't have a proper business enterprise in India because they said, people just subscribe and we all pay online through our credit cards. Even now, App Store, when we download some apps for money, payment goes through the payment gateway. So therefore, there is no need for me to gone out those days from brick and mortar. I use this term from brick and mortar. We have gone to click and order. So from brick and mortar, our evolution has gone to click and order. So we just click and order. I don't need to. So this is the evolution of digital. So therefore, these online digital giants have not, as we said, there is no need for tax, and we have subsequently a lot of judgments also. He said, going by the law, going by principle, there is no permanent establishment. This is not a fees for technical services because everything is automated. There has to be a human intervention. And 3, this is not a royalty. And many of India's treaties has this same method. In fact, your royalty FTS, are actually in your domestic is inspired from your treaty. So all the so therefore, even assuming you change the act, even you amend the act, what will happen? Section 90 will come for the foreign companies relief, which says Income Tax Act or DTL, whichever is beneficial to associate, I can take. So even you amend the definition under the act, the treaties will still contain the same definitions. Like for royalty, there has to be a right to copy. These are all not copyright material. They're just use of a space. Similarly, FTS is for long referred to as human services is required, and business income P, and P is a 100-year-old concept. So these are all cases, classic example of how businesses have evolved and law are still catching up. And of course, one of the efforts to catch up is equalization levy. So this was addressed in the BEPS action plan, and therefore there was an option that was given to. So a lot of companies were saying, hey, look, this is a problem for us because these companies are not paying taxes, and our courts have also agreed. So how to do it? So under action 1, this action 1 is not finalized yet, but there were recommendations given for countries saying you change your, let's try to change the PE definition under the treaty and under the act to bring it in line with the modern day businesses, or let's bring a withholding tax on digital transactions. These are options proposed. And another option proposed was bring equalization levy. Now, what is equalization levy? So India actually have adopted all the three, meaning if you remember, India, we have amended section 9(1) to introduce something called significant economic presence, but this provision is not active yet because we're waiting for a global consensus, because merely amending the act is not going to help you. So a treaty also has to be amended. Treaties are bilateral treaties. So other countries should also accept. And this is where politics comes into picture. USA has all these major companies, Google, Amazon, Facebook, Apple. If you look, all are US-based companies. So US is saying, I will not agree to amend the treaty because they are saying India should not get any taxing right, because this Yahoo algorithm or Google algorithm or Apple technology, everything is created in US. So value creation happens only in my place in US. So why should India take? But India's contention is that's a very bad argument, US, because if you don't have a market, if you don't have demand, where is the supply? It's a chickening story. US says to hell with it, only there is a supply, demand is coming. India says demand is there, that is why you are able to supply, and the demand is coming from the market economy. It is the Indians who are using Facebook, social media. Indians are, because of population and young population, and with the technology pervading, Facebook, Instagram, name all the social media, we are top, be it WhatsApp, we keep sending good morning messages, number one. So India is there everywhere. So we consume data, internet. So therefore, because of us is how your value is going. So you should pay tax. So this is the tussle that is going on. I will not get deep into it. So what India did is, the discussions are still going on. So this discussion started in 2013. This report came in 2015. We are in 2020. They are hoping by 2021 we should get into some consensus, because multiple countries are involved. So you need to amend the treaty and all those things. But as of now, it is still consultation, negotiation going on. But what India did in the meanwhile in 2016 is, to hell with your negotiations and all those things, I'm going to introduce equalization levy. Even though this is introduced but not active, it is only expected to be active from next year. But India went ahead and introduced something called equalization levy, which was actually proposed by the OECD BEPS action. We are going to see what is equalization levy. Now, equalization levy, one thing you need to know is, you will not find this in the Income Tax Act. You will find this in the Finance Act, and it was introduced in Finance Act 2016. Because 2015, the BEPS report, this report suggested these options in 2015. So immediately next year, India formed a committee, and then in 2016, this was introduced as part of your Finance Act. This will not be there in your 1 to 298 of your Income Tax Act. Now, why? Why it was introduced in Finance Act? No brainer, very easy answer. Because this was a unilateral measure. What is unilateral measure? I myself, India is not, actually, they don't want to listen to US, they don't want to listen to China. They're saying, I'm going to introduce. So therefore, to avoid Section 90, what the Section 90 says, we discussed this, treaty or act, whichever is beneficial. So people were taking treaty benefit. Now, the government, what they did very smartly is, this is a Finance Act levy. That's why they use the word equalization levy. They don't call it equalization tax. They call it equalization levy. And then they are saying this is not income tax. And this is a new kind of, you call it tax or whatever it is. This is a new kind of a levy by India. And this is coming under Finance Act. The idea is they don't want Yahoo USA or Google USA to take treaty benefit. Because they will say, look, if it is only a treaty, if it's only an income tax levy, income tax charge, then you can take treaty. This is coming under Finance Act. When you and me entered into a treaty, we talk only about taxes under the Income Tax Act. Finance Act is my mother act. I can introduce whatever I want. So the reason for introducing under Finance Act is not to give treaty benefit. There are a lot of controversy going on to it, but you don't worry about it at your level. That's for policymakers, countries to decide, taxpayers to fight in the court. Till date, we do not have any judgments yet. So therefore, I'm not even getting in that area. But the issue is the reason for introducing. You need to know why it is introduced under the Finance Act 2016, Chapter 8 of the Finance Act was introduced. So you will find equalization levy provisions. When you go to incometaxindia.gov.in, you have to go to Finance Act to find out the equalization. You will not find it under Section 1 to 298. Section 163 to 180 governs equalization levy under the Finance Act. But one very interesting aspect which I want to tell you is, even though it is as part of Finance Act, it is largely governed by income tax. How? Why am I making this statement? Because the equalization levy provision says, wherever you are not able to find any definitions, go to Income Tax Act for any definitions. And also they are saying there are some provisions of income tax like search, seizure, assessment, and all those aspects, penalty, provisions, prosecution, all those things, survey, they're all being mirrored from income tax. So you can call it a surrogate income tax, but the fact is the government does not want to call it as income tax, because if you call it as income tax, then you will be bound to give a treaty. So they are keeping quiet. All these things the government is doing is what the government is trying to achieve is they want to make a political statement. They want, because today India cannot create something like Google. I'm not undermining it. Let's accept the fact. We can proudly say a lot of US companies are headed by Indian origin or Indians, NRIs. But the fact of the matter is we do not have a Google. We don't have a Google. We don't have a Facebook. We're not like China, where we can ban Google, Facebook, and have our own Baidu and Alibaba's. So the fact of the matter is we are dependent on these US companies which govern the rule for whatsoever reasons. So the fact is, since we do not, they are monopoly. Google is a monopoly. Facebook is a monopoly. Instagram, WhatsApp. You all say all these are US entities and they rule the rules. So therefore, what the government decided is, India will always be a market economy because we will only have users. So they said, there has to be a parity. Give us some taxing, give us some money, because only because of these Indian people, we keep accessing your Facebook, we keep opening social media accounts, we keep downloading WhatsApp, we keep using Google, and we give a lot of data. So therefore, you should also give us some share of your profits. Whatever profit Google USA makes, whatever profits Facebook USA makes, India says, give me some share. But USA says, go to hell. I'm not going to give you, because the value creation happens only in USA. So this is a political conflict that is going on. So leave that as it may. Just wanted to give you a heads up on how politics is now playing a major role in international tax. But coming back to equalization levy, so what India did is they went ahead, and introduced equalization levy, basically to tell that we are not going to keep quiet. We are not going to succumb to you. We are here to fight. We want our share of revenue. That's why the entire world is looking at India, because India is fighting against the bigger countries, especially USA. So they went ahead and introduced equalization levy in 2016, and that is what we are going to see now. So this is the broad. So by now you would have got a hang of it. The idea is to tax foreign digital companies who do not have any presence in India, but they have a huge market in India. So India is saying, even though you are not doing business in India, you may say you are doing business in India, but the fact of the matter is, by huge number of users, you are essentially trying to do the businesses have evolved. Just because you don't have a permanent establishment in India does not mean that you should not pay certain portion of your profits in India. So India is trying to come out with a virtual PE or a significant economic presence, fictitious PE, intangible PE. And COVID has also exacerbated how technology has evolved today, thanks to Zoom and various aspects. We are able to do a lot of things. So taxation. So this is the issue with regards to digital economy and how technology has evolved. So with this, let's get to the provisions of equalization levy. Now, what equalization levy says is, this equalization levy is only applicable for non-residents, because they want to target only these non-residents. Why they don't want to target residents? Because residents are anyways going to come under the Income Tax Act 194. The 194O was recently introduced. 194J will be there. 194C is there. So, or even assuming TDS is not there, you are going to pay taxes. So that is why, in order to bring these non-residents equal with resident e-commerce providers or resident digital companies, the name is called equalization. So I want to equalize them. So that's why the name is used as equalization levy. Treat non-resident companies at par with resident companies, because if it's a resident company doing these activities and getting money, they will pay income tax in India, corporate tax, whatever tax in India. But these non-residents get money from India, don't contribute anything to India, but they are getting the money only because of India as the India's contention. Now, what does equalization levy says? Equalization levy says 6% is taxable on the amount of consideration received by a non-resident for any specified services. Now, what are those specified services? Specified services means online advertisement, provision for digital advertising space or any other facility or service for the purpose of online advertisement, and any other service as may be notified. So till now, no service has been notified. So effectively, if you see, this is one scope. There are actually, in 2020, there is an amendment, which is equalization levy 2.0. I'll come to, let's first finish the 2016 1.0 amendment. So equalization levy will come for two kinds of transactions. So now we are looking at the first kind of transaction. The first kind of transaction, when it was introduced in 2016, was any payment made to a non-resident by a resident or a non-resident having a P in India, because they are both treated the same way. So let's say a resident is making a payment to a non-resident for any specified services rendered by the non-resident. What is the specified service rendered by the non-resident? It should be online advertisement, provision for digital advertising space or any facility for the purpose of online advertisement, and any other service. Any other service has not been notified. So all you need to, for first transaction is any services for online advertisement. So very clearly they are targeting Google, or it can also be Facebook, because you have some advertisements coming in Facebook, or advertisement in LinkedIn. So basically the social media companies where I go do a online advertisement. So therefore, a resident service, a resident making a payment to a non-resident service provider who provides services for online advertisement, then in that case, you have to make a payment of 6% on the consideration. So let's look at an example to understand this better. Anil's son Sunil had obtained a rank in CA final. To celebrate Sunil's achievement, Anil gave an online advertisement and wanted to publish a congratulatory message with Sunil's photo. I believe a lot of you guys do this. When people clear, they congratulate, put in newspaper, local newspaper. So here, obviously, we have grown in the digital world. So Anil, celebrate Sunil's achievement for passing CA, gives an online advertisement publishing a congratulatory message with Sunil's photo. So in this regard, he approached Mrs. Proud GmbH, a German company, to publish the online advertisement. So this German company is an online advertisement service provider. This is like your ad agency. So they'll help you in customizing your ad, and they will have slots with Google, Facebook, depending upon. So Anil approached this German company and said, you publish this message, for which 5 lakhs was paid by Anil to Proud GmbH, a German company. Discuss the implications of EL for Proud GmbH. So now there is a resident. There is a resident here. He's a resident. And Proud GmbH is a non-resident. So a resident making a payment to a non-resident. So EL is chargeable at the rate of 6% on the amount of consideration for any specified services. So what services? Online advertisement. So this is for online advertisement. So it looks like EL is satisfied. But hang on, there are some exclusions to equalization levy. It is not applicable for B2C transactions. That is, here it is only a customer and he is not doing any business. So therefore, since Anil is not doing any business and this is for his personal capacity, this is for his personal purposes, there is no business, this is only personal. So therefore, equalization levy not applicable. So this is one scenario. So again, makes it very clear, they are targeting only where you try to exploit businesses. So since this is for personal purposes. The payment by the buyer is for personal purposes to a German online advertisement service provider. This is excluded under the equalization levy. So I wanted to bring this to your attention that there are some exclusions to equalization levy. One of the exclusion is if it is a personal transaction or a business to customer transaction. Now let's go to the next second question to see when equalization levy can be applicable. Oh, you're not able to see the question. Neil says, why can we find the question? So these are questions drafted by me, so we will share it. But I hope you're able to see the question. Please let me know if you're not able to see the question. I'm showing a Word document which has these questions. All right, so let's move on to second question. So the first question, I hope you are clear. For equalization levy, there has to be a resident service recipient. So a payment has to be made to a non-resident service provider, and it has to be made from a resident buyer, and it should be for online advertisement. However, there are some exclusion. One of the exclusion is if it is for personal purposes or between B to C, equalization levy won't trigger. Now let's look at the next question. Beta Private Limited is an Indian shoe brand. Beta Private Limited is an Indian shoe brand. In order to expand its business, outside India and to take the brand global, Beta India had engaged in April 2020 an Indian technology service company, Bisadopt, and paid INR 2 lakhs for the services. So what Beta did is, Beta is a popular Indian shoe brand. So now it wants to go global and reach out to youngsters or digital, not visible company. Neil says it's not visible. You can try to make it visible. I hope it's visible now. We are in question number 2. Please put in the Q&A box if it's visible. So coming back to question number 2. So the Beta brand wants to take its brand global. So what it wants to reach out to more people, since they felt that it will be better to go digital in order to promote their brand. So what they did is they engaged an Indian technology service company, Bisadopt, and paid them 2 lakhs. So Bisadopt is an online ad agency, a tech company, which will try to do all this ad, and then they will appropriately publish it in Google or Facebook or depending upon. So they are a ad tech company. So now this payment is being made by a resident, which is Beta, and this is for online advertisement. So which is a specified service under equalization levy. Equalization levy, specified services. One of the specified services is, we saw 165. One of the specified services is online advertisement. Specified services. So since online advertisement is one of the specified services, so that is also satisfied. But who is the recipient? The recipient here is an Indian company. So BizAdopt is the service provider who is a resident. One of the major condition for section 160 equalization levy to applicable is the consideration, that is the service provider should always be a non-resident. We are trying to target non-residents. The equalization levy was introduced to bring into tax the non-resident digital companies who don't have a presence in India but make a lot of money from India. So that was the reason for equalization levy to be introduced. So therefore, the condition applicability of equalization levy is there has to be a non-resident service provider who should be the recipient of the consideration. The person who should be paying should be a resident, and it should be for a specified service. What is that specified service? Online advertisement. So here only two conditions are satisfied. Online advertisement, payment is made by a resident. The recipient is an Indian company. Therefore, equalization levy for BizAdopt not applicable. Logic is again very simple. The money doesn't move out of India. It stays within India. So therefore, there is no profit shifting or base erosion that happens. Now let's look at the second part to the question. Beta was not satisfied with the Indian company. So therefore, in July 2020, it engaged a foreign company in Ireland, Messrs. Moon Irish Limited, a technology company for the purpose of online advertisement, and paid INR 50,000. So what happened was Beta engaged a Irish company, Moon Irish Limited, a technology company for the purpose of online advertisement. So therefore, now we need to see whether equalization levy is applicable. First condition, it has to be a resident should pay. Resident should be the payer. Is a resident payer? Yes. Beta is a resident. 2. The recipient should be a non-resident. Is he a non-resident? Yes, because it is an Ireland company. Third, it should be for online advertisement, specified services. Is it online advertisement? Yes. So all three conditions are satisfied. Equalization levy is applicable. But hang on. Equalization levy gives a threshold, just like how we have threshold. So they have a threshold, but the threshold is a very small amount. Threshold is just INR 1 lakh. So therefore, the threshold here is this is the threshold. So the threshold here is INR 1 lakh. So now come back and see here. The payment is 50,000. So everything else is satisfied, but threshold is less than 1 lakh. So therefore, equalization levy not applicable. I'm giving you these variations because this is how they try to test for 6 marks or even for multiple choice question. What is the threshold limit? And whether equalization is applicable for a resident service provider? No. So therefore, in the first case, since this was payment made to a Indian company, the service recipient or the consideration was received. The service provider and the consideration was received by a resident company, equalization levy not applicable. The second situation, The service provider was a non-resident, service recipient was a resident, payment was for online advertisement, but however, amount was only 50,000. If the amount threshold is 1 lakh. So therefore, equalization levy is not applicable for the second question. Now let's go to question number 3. So through these questions, I am trying to make you understand the provisions. So as I mentioned to you, equalization levy is a straightforward provision. So now let's try to, we're going to the other variation, question number 3. If you have any questions so far, please do let know. Okay, Neil has a question. If consideration given in foreign currency conversion rate, what would be the date for a transaction? So that is similar to your TT buying rate, your SPay. So therefore, whatever income tax rules, even for deduction and all those things, whatever you apply for your income tax will apply. So equalization also has a rules. So it is the TT buying rate of the last month or the date before. So similar to what is there in the income tax, even for withholding equalization. I'll come to that part. Since Neil asked about the currency conversion rate, the date of transaction will be similar to what is there under the Income Tax Act. So that's why I said, even though it comes under Finance Act, it is largely governed by income tax. So even if the equalization levy rules does not specify, you can go to income tax and take that as a guideline or a reference factor. Now coming back to our next question. So we are here in this question. Pentagon Private Limited, which is also an Indian shoe brand, in November 2020, in order to popularize its brand globally, engaged VU GmbH, an Austrian technology company. So Pentagon, an Indian shoe brand, engaged an Austrian technology company and paid INR 25 lakhs for online advertisement. It is also noted that the Austrian company does not have any PE in India. So the Austrian company does not have. Now whether discuss the applicability of equalization levy. So let's look at first whether the payer, the service provider, service recipient, is he a resident? Yes. The service recipient is a resident, he is going to pay. Next, whether the consideration received or the service provider, is he a non-resident? So whether the non-resident is getting any consideration from an Indian company, yes, it is an Austrian company, it is a non-resident, and it is also the service provider. So therefore, consideration is received by a non-resident from a resident, paid INR 25 lakhs for online advertisement. So for what? Is it a specified services? Yes, it is a specified services, online advertisement. So all three conditions satisfied. Next, threshold. Has a threshold increased 1 lakh? Yes. Threshold has also increased 1 lakh, 25 lakhs. And it does not have any PE in India. So that is also mentioned. Just hang on with the PE part because that's the second part of the question. So now, if it has a PE in India, if VU has a PE in India, then equalization levy won't be applicable, exclusions. This one. So last exclusion is the non-resident should have a P in India. If it has a P in India, then equalization levy won't attract. So in the given situation, the question says it does not have any P in India. So therefore, equalization levy will attract. I repeat, equalization levy will attract because the payment is by a resident, Indian resident, to a non-resident service provider. And what is the service? Is it online? Yes. Online advertisement. Has it increased above 1 lakh? Yes, it is 25 lakhs. Does it have a P in India? No, it does not have any P in India. Then equalization levy is applicable. Equalization levy is applicable. If it has a P in Chennai, India, then equalization levy won't applicable. Why? Very simple logic. If it has a P in India, then income tax can always tax this P and recover because it has a branch office. It may be something so very easy to recover. So therefore, if it has a P, then they are not worried. So we are trying to. This is the objective. We are trying to tax those companies which do not have any presence in India. They operate outside India and they take all the money. So we are only trying to catch those foreign companies who make money from India, but they don't contribute. So the idea is only to target them. If they have a P in India, then I don't need to worry because I can always collect the tax from the P. So therefore, keep this objective in mind. Equalization levy, since in the given case, the Austrian IT company does not have a P in India, equalization levy will attract. So these are the aspect one need to keep in mind to check the applicability of equalization levy. So equalization levy again, I repeat, covers payment made by residents to non-residents who are providing online advertisement services. And if these conditions are there, equalization levy will be chargeable at the rate of 6% on the amount of consideration. So coming back to this question, here equalization levy will be 6% of 25 lakhs, which is 1.5 lakhs. I hope I'm right. So therefore, equalization levy of 1.5 lakhs has to be paid. I hope you guys are clear up to this point. Very simple, straightforward. All you need to know is whether the recipient, the money consideration recipient is a non-resident, and if he's providing online advertisement and that amount is paid by a resident, then equalization levy will trigger in this transaction 6%. The rate, remember, for online advertisement, it is 6%. I repeat, you may have a multiple choice question. It is for 6% on the consideration paid. The consideration paid is 25 lakhs. So on 6%, 25 lakhs, it is 1.5 lakhs. Now go to the next question. Who will discharge the EL? So the question is, will the non-resident, that is, will WA Austria, will it pay this 1.5 lakhs or will it have to be paid by Pentagon, Indian company? So now for this services, what equalization levy, that is your 165 to 168. Okay, this should be there in your study material. So this payment has to be, equalization levy has to be deducted from the amount paid or payable to a non-resident. So therefore, the onus is on the Indian service recipient, which is Pentagon. So Pentagon has to withhold, has to deduct, like your TDS, equalization levy has to be deducted. Yes, 6% on INR value. You have to convert it into Indian rupee, and then so whatever you might have entered for $10,000, 50,000 euros, convert it into INR, and on that INR 6% you have to withhold. You, when I mean you, the Indian service recipient has to withhold. So in our case, it is the Pentagon India will have to, while making the payment of 25 lakhs, will have to withhold. It will have to minus 1.5 lakhs and pay the balance 23.5 lakhs to the Austrian company. 1.5 lakhs will go to Indian government as equalization levy. So the collection mechanism, the discharge, the onus is given to Indian company here. So please watch out. Equalization levy 1.0, that is for the online service, online advertisement. The onus is on the onus to collect the amount and remit it is on the Indian service recipient, the payer. So the resident payer has to do the obligations because it is very difficult to get this money from, collected from the Austrian company. He will say, I will not come, I will not pay. So it becomes a very diplomatic tax collection, all those process, you have to invoke treaty. So therefore, what they have done is they have smartly given the burden to the Indian provider. So now, so this is the broad provisions of equalization levy. Now, going further, the Indian company wants to understand. We are in question number 5. The Indian company wants to understand whether the India-Austria treaty can be invoked to determine the taxability. So so they're asking, can I look at India-Austria and try to see whether this transaction is taxable or whether Austria has the taxing right? Now the answer to it is no. You cannot take India-Austria treaty because this is introduced under the Finance Act and not under the income tax. This levy is under the Finance Act and not under the Income Tax Act. So therefore, I cannot invoke Section 90. This is one of the main reasons for introducing under the Finance Act. So question number 5, I hope you are clear. No treaty benefit can be taken. Now let's go to question number 6. So question number 6 says, they have this on one moment. I'm just trying to push this. Yeah. All right. So let's look at question number 6. Apart from discharging the EL, what are the other obligations to be undertaken by Pentagon Private Limited? So these obligations are very similar to what you do under your income tax TDS. That is, the Indian company should deduct. The Indian company, after deducting, should pay to the credit of the government within the 7th day of the following month. So if the transaction is done on 30th November, before 7th December, the equalization levy has to be remitted to the government. Failure to deduct, the assessee shall be liable to pay the amount of an interest. So, sorry, if the assessee shall be liable to pay the amount of levy to the government. That is, if there's a failure to deduct, then what they are again going is, if I don't deduct, that is, I have paid 25 lakhs. When I mean Pentagon has paid 25 lakhs, it should have actually deducted 1.5 lakhs as equalization levy, but it fails to do it. It fails to do it. Then what happened? The income tax authorities won't go to WU Austria, the technology company. Instead, it will come to Pentagon and say, pay the 1.5 lakhs. So, if I fail to deduct, the liability is on the Indian resident service recipient. So, look at it, very, very onerous. So, that's why it is very important when we advise, we have to be very careful in advising our clients who make these payments to non-residents. So, therefore, under equalization levy 1.0, that is for the first transaction, which has online advertisement, the condition is the Indian assessee, who is the service recipient, should pay the amount of levy when it has failed. So, the collection will happen from him, and interest will also be collected 1% on the failure amount, which is 1.5 lakhs we saw in our example. Not only that, penalty will also be there. Penalty will also be levied for failure to deduct and deposit. And there's also other procedure. You can please look at this. I'm not spending my time on that. There are other procedure like, just like how you file your TDS returns, you should also file a statement here. Equalization levy, you have to furnish a statement. When I mean you, the Indian who is discharging has to deduct, deposit, also file similar to TDS returns, should also file the equalization levy statement. If that is not done, penalty again 100 rupees. If interest penalty, interest is there. If you don't remit it, penalty 1000 rupees per day. So these provisions are there available. Please have a look at it. So you basically ensuring that the Indian service recipient properly complies in equalization levy. Penalty of rupees 1000 for each day. Failure to furnish the equalization levy statement, which is akin to your TDS returns. Now, once all these things are done, your assessment process also happens. How assessment is? The assessing officer will check whether everything is there, and then he'll accordingly pass the order. If you have not furnished it, he will send you a notice as to why you have not furnished it. So look, these are the penalty. Failure to deduct amount equal to levy payable. Failure to remit the remittance 1000 rupees per day. Failure to furnish statement, your TDS return kind of equalization statement 100. So these are procedural aspects. Please look at it. They may ask you these questions, maybe in the multiple choice question. What is the interest for delayed payment? 1% or interest. Similarly, when should you deposit? Within 7th day of the next month. Now, I have two other questions. Penalty, the Pentagon. So, 7th question is we have already covered. Has failed to discharge the EL obligations. What are the implications under the EL? So, I've told you the implications are interest, penalty, everything will come. Similar to what is done under the Income Tax Act. Failure to discharge, failure to furnish, penalty for failure to discharge, penalty for not furnishing the equalization statement, and interest will also attract. Now let's look at question number 8. Another Indian shoe brand, Shadim's India, approached the same Austrian company for online advertisement and promotion. The consideration to be paid by Shadim is 25 lakhs. Further, as part of the contract, any taxes to be deducted in India by Shadim has to be borne by Shadim. Kindly advise the EL implications. Same, the WU technology company does not have any PE. So the only variation to this question, the point what I want to stress here is, what the Austrian technology company realized last time is, I asked for 25 lakhs. I was told by my Austrian tax consultant that there won't be any tax in India, but I'm surprised to see an equalization levy, which is a unilateral measure by the Indian government. I cannot even take treaty. So when there is no treaty, I cannot take credit in my country. So they found out that my net revenue was only 23.5 lakhs. 1.5 lakhs went to the Indian government. So what they did very smart next time, when the Shadim company, another Indian company approached, they said, look, I want 25 lakhs. Any tax, all those things, you have to bear it. This is as per the contract. Yeah, Vignesh has raised. Vignesh, I'll come to your question. That's my 9th question. So coming back, so therefore the question here is, the Austrian technology company is smart enough to say, I want 25 lakhs. If you are going to deduct, you have to bear the cost. This is something very similar to 195A, grossing up. I'm sure you all know grossing up, whereas the contract says the tax has to be borne by the Indian company, then Indian company will gross it up. So 100 rupees, the non-resident says, I need 100 in my pocket. So we gross it up to 110 and then deduct, it will come to, and the non-resident will take his 100 rupees. But what is very important to know here is, there is no grossing up 195A equivalent provision, 195 of the Income Tax Act, which allows for grossing up. There is no equivalent grossing up under equalization levy. So which means the government is saying to the Indian service recipient, don't encourage these kind of transaction, don't gross it up. So if the Shadim says, okay, 25 lakhs I will pay to W as per the agreement, and then gross this up 25 lakhs into 106%, and then accordingly pay the EL to government, that is not allowed under equalization levy. 195A allows you grossing up for TDS under Income Tax Act. This is Finance Act. You cannot do grossing up. So please keep that in mind. So therefore, Shadim should go and tell to Austria, I cannot do grossing up. If I do grossing up, my Indian government will penalize me. I cannot do gross. There is no 195 equivalent. So I will only pay you 23.5 lakhs, 1.5 equalization levy. Now, practically what happens is, this is bargaining power. Imagine Shadim telling Google, go to hell, I will not pay you. Google will say, get lost, Shadim. Shadim goes, somebody will come. Beta comes, Pentagon comes, some company will keep coming. I'm monopoly. So practically these issues are there. They don't agree because bargaining power. Because to me, I want Google, because everybody goes to Google. I cannot go put it in some online web provider, web service search engine where nobody goes. Yahoo is dead. Can I say, good at Yahoo? Nobody. Look at the 2009 Right Flores. At the time, Yahoo was there. Now in 2020, nobody uses Yahoo. If we all immediately go to Google, maybe now some of us will go to Bing or Microsoft Internet Explorer Edge. But otherwise, predominantly, we all go to Google search. So therefore, Google dominates. So practically, these are the issues that happens. But anyway, from a legal provision, all you need to know is there is no grossing up. No concept of grossing up. Now, this brings us to the last aspect under the first kind of transaction in equalization levy. This is a question that is also raised by Vignesh. Interplay between equalization levy and Income Tax Act. Whether assessing officer can also invoke income tax on Bayou, Austria over and above the EL. So, what a smart assessing officer does is, look, EL is not Income Tax Act. This is separate 3%. So this transaction, I think it will come under FTS. So therefore, you should pay 10%. Now, thankfully, section 10, clause 50 is not subsection, read properly. 10, clause 50. I hope you all know the difference between clause and subsection. Section 2 में जो भी आ रहा है वो सब clauses है, they're not definite subclause, subsections. I see people reading 2 subsection 15 wrong. Similarly, I see 10 subsection 34, 10 it is called 10 clause 50. So if you go to 10 clause 50 of the Income Tax Act, if any amount is coming under EL, then that amount is exempt. So don't worry, they will not harass you under income tax, no problem. So income tax gives you a benefit under section 10 clause 50 for any non-resident online advertisement company, if they have suffered equalization levy, that non-resident company will not again be asked to pay tax under the Income Tax Act. Only one time paid 3%, 2% equalization levy of my apologies, 6%. Sorry, 6%. Yeah, 6% equalization levy. They will not ask you to come under, they will not ask you to pay additional FTS. So please remember this equalization levy only 6% for online. I got a question from Neil. So contract should only mention price exclusive of equalization. Normally, contracts, what these non-resident companies do is they will tell this is my amount of consideration that you need to pay me. Any taxes, any levy, whatsoever name called, you take any commercial contract, they will say any tax, levy, fee by whatever name called has to be borne by the service recipient. So they normally do that. So what happens is income tax also allows 195A crossing up provision. Now you may always ask why India introduced this crossing up. Ideally speaking, India should not have introduced crossing up, but the reason logical, I'm assuming they could have gone cross up is one, more revenue, because 100 rupees is what I'm going to pay to a non-resident. Under the Income Tax Act, 100 minus 10, 90 pay to the non-resident, 10 to government. But if I gross it up, 100 and gross it, I get extra amount. Instead of getting 10, I get 11 rupees. Because grossed up amount will go to 111 or 112. And government also said we wanted to discourage people from importing services. They don't want you to, because you're importing services for which you are paying. They said, I want to promote my domestic service providers. So they wanted to discourage people from taking service import. They don't want you to approach non-resident people. So that's why they introduced grossing up pay. But now what they did under equalization levies, they said to the Indian guys, you don't bear the cost. Because if grossing up is allowed, here what would have happened? 25 lakhs, he would have got it. Look from an Indian company perspective. They charge him 25 lakhs plus the 6% gross up will be his cost. So it will be somewhere around 26 or 27 lakhs. So he will have to pay additional. The cost is that, and this 27 lakhs, the burden, he will pass it on to Indian customers. So therefore, what the government said is don't do any grossing up. I'm not going to give 195A equivalent provision. So anyway, you don't need to worry about the practical aspect. In the exam, they may ask you whether grossing up. No, there is no 195A equivalent. That is what I want to ensure. Okay, so I have one question from Hema. By mistake, I'll read the, I don't know if you guys are able to see. If by mistake 25 lakhs is remitted to non-resident, then Indian company has to pay 1.5 lakhs, correct? Is this not allowed only because mentioned in contract? Can you please explain these two questions? I'm not able to exactly understand, but anyway, I'll explain the concept. What I mentioned is, Hema, look here. See this 25 lakhs is the agreement entered between Shadim India and Austrian guy for online advertisement. So now the Austria says, last time I did a similar transaction with Pentagon. These guys deducted 6%. So I only got 23.5 lakhs. So they are very smart now. They are saying, no, pay me 25 lakhs. Any taxes in India, whatever name called, you bear it. This is what we call legally grossing up. So now, what will happen is, purely going by commercial, what Shadim will try to do is 25 lakhs pay to Austria. He will gross it up. And then let's say the grossing up comes to the equalization levy after grossing up comes to 2 lakhs. 2 lakhs pay to Indian government. So the cost actually, if you see, it is 27 lakhs because of grossing up. Ideally, it should be 25 lakhs minus 1.5 lakhs 23 minus 20. So the cost should only remain 25. 1.5 go to government, 23.5 should go to VAU. Now, by mistake, not by mistake, going by contract, had you paid 25 lakhs and you gross it up and pay, Indian government can come and levy penalty provisions. Can levy saying, how can you do this? Why did you gross it up? Your consideration paid is only 25 lakhs. And I have clearly mentioned in section 165A, 6% should be the equalization levy. So on 25 lakhs, you should have paid 6% equalization levy. Why did you gross it up? So they can levy penalty provision because there is no 195A equivalent. That is what I wanted to mention to you. So what we have to do is we should tell WU, no grossing up allowed. So the point what I wanted to highlight is there is no grossing up. Practically, there are a lot of issues. Let's not worry. Again, at the exam level, they will say whether is this whether grossing up is whether can Shadim do a grossing up? Can this contract be valid? No, this is not valid because equally there is no grossing up mechanism under the Indian legislation. So, got it. Equalization levy is crystal clear. Vignesh found it pretty. So, therefore, to sum it up, we are not done with equalization levy yet. We are done with one part of equalization levy. So, to sum it up, a non-resident getting services on online advertisement from a non-resident non-resident, then in those cases, the resident has to discharge equalization levy at 6% for online advertisement. That the 6% equalization levy, the honors, collection, all those things, including assessment, is under the ambit of the Indian payer. So he has to bear it. Sumit, I'll answer your question. So therefore, with this, we are done with one level of transaction, the two types of transactions. So we're done with first set of transaction, which is for online advertisement services. Now, in 2020, when the budget was there, we never had any equalization in the finance bill. Suddenly, when the Finance Act passed, we were all surprised to see a expanded version of equalization levy, which is called Equalization Levy 2.0. We're all, why this is 2.0? Globally, they have kept the name as 2.0. I think we're all, sequels. You can call it also season 2 because 2016 we only had one transaction. 2020 they have expanded the scope. Now, actually speaking, the idea of equalization levy was a temporary measure. Once the global consensus is emerged, once they have identified how to tax digital companies, India wanted to abolish equalization levy. So it was supposed to be a temporary measure. But Finance Act 2020 gave us all a surprise where the Indian government went one step and expanded the scope of equalization levy. So we until April 2020, we only had until the Finance Act 2020, we only had one services, which is online advertisement. You all saw, but now equalization levy 2.0, as you know, there are sequels. We also have a sequel in equalization levy. The saga continues. We have an expanded scope. And what is that expanded scope and how does that work? Is there any difference between 1.0? We will see that after the break. So we will take a quick 12-minute break. We'll reassemble at 8. And then we look at the second leg of transaction that will come under equalization levy. So take a break and then we will meet you. I'll meet you at 8 o'clock. All right. Welcome back. Okay, perfect. Thank you, Jay. All right. Welcome back. So, yeah, obviously, before we went on the break, the interval. So, we're going to start season 2 for Equalization Levy 2.0. But then, just as always, have you seen in any series before season 2 starts, they will obviously give a quick recap of season 1. So, season 1, we saw the Equalization Levy 1.0. So, basically, what is 1.0, 2.0 is there are two kind of transactions. So, we saw first kind of transaction, which will come under Equalization Levy. And now we are going to see second kind of transactions, which is colloquially globally called as Equalization Levy 2.0 by the fraternity. So Equalization Levy 1.0 is on online advertisement services by non-resident. So any non-resident providing online advertisement service to a resident, then the resident has to discharge 6% as equalization levy. The reason for introducing equalization levy is these tech companies were avoiding taxation in India because they never had any nexus in India. So they said there is nothing is taxable. So therefore, and they were taking treaty benefit also by using the very archaic concept of PE. Permanent establishment is a 100-year-old concept which was set up during the industrialized period in Germany, in Europe. So therefore, in line with the modern day, since the treaties are also not in line with digital evolution, India smartly, to avoid people taking treaty benefit, introduced it under the Finance Act. So this is equalization levy. Now this is an interim measure because they're waiting for globally countries to come to a consensus, and tomorrow you will see the treaties being amended to in line with the modern day businesses. So these modern day businesses largely due to digital evolution or technological epoch. Now, so we saw equalization levy 1.0 on online advertisement. Now let's go to 2.0. Now again, 2.0, the premise, just like any, of course, in India, you see a lot of the sequel movies will have no relevance to the first. Only that they will want to make use of the franchisee. The name alone they want to tag. But unlike that, this equalization sequel or 2.0, the premise still remains the same. That is, the digital companies still trying to avoid the taxation in India. So therefore, this is again applicable only to non-residents. Now, just to set the tone for the equalization levy 2.0, the second kind of transaction under equalization levy. So this is something which you should have heard, and this is a clipping from the social dilemma movie which I was talking about. If you're not paying for the products, for Facebook we don't pay, for Google search we don't pay, for Instagram we don't pay, for WhatsApp we don't pay to access these apps, social media. So if you're not paying for the product, then you are the product. So all our data is what these not necessarily data or model and all those things is how the technology companies evolve and try to make use of it. So keep this in mind, and we'll go to equalization levy 2.0, or the second kind of transaction introduced by the Finance Act 2020. So this is applicable for assessment year 2021-22. Now, first we saw for online advertisement, that still remains. So that continues. So this is next additional scope expanded. So to whom have they expanded? So here, equalization levy 2.0 will attract for e-commerce operators, for non-resident e-commerce operators. So in the first leg, if you see, we were talking about online advertisement. So there was no e-commerce. Today, e-commerce has evolved. Digital evolution, especially digital commerce, we all do e-commerce, and COVID actually helped. And we all know during the Big Billion Day or the Amazon Prime Day, and for every other thing, not necessarily goods or services, even for haircut and all those things we do online. So and of course, I don't need to mention to you all how e-commerce evolved, and that's how it's been part of our life, day-to-day life. So that being said, for resident e-commerce operators, 194O is there. That's a new amendment that will be covered as part of your TDS provisions. For non-resident e-commerce operators, because in India, still there is no proper regulatory guidelines in terms of e-commerce. So there was a white paper introduced by the RBI, but then still yet to come to this thing, because these are businesses which nobody anticipated. So therefore, we do not have a regulator. And these are all what they are basically. E-commerce operators are like your marketplace. So what do they do in a non-digital world? What will we do if you want to start a brand? You have a brand. Say let's say your brand is called some Indian brand. Say Anjali. Now, so what you do with the Anjali brand is, what in a normal scenario, what you will do is you go to a mall, and in the mall you open a store, and then people will come, shoppers will come, you know they look at this thing, and then you'll buy, sell. So the same mall concept, if you juxtapose, if you put it in online place, so what the likes of Amazon does it, they act as a marketplace. So they are like the mall owner, and then they invite all the sellers. Instead of setting shops, they can list their products, and you and me are like, people who go to the mall shop are buyers. So it is just a that's why it's called marketplace. These are called online marketplace because you can relate it with how the malls and other market areas work. So these e-commerce operators business, nobody would have anticipated an amount of growth. And today, we buy everything from vegetables to healthcare products, to a haircut, to sanitation, whatever you want, everything is done online through e-commerce operators. And growth has been that significant. So for non-resident e-commerce operators who do e-commerce supply or services, so for again, watch out, non-resident e-commerce operators who are engaged in e-commerce supply or services. So we'll see who an e-commerce operator is. I've already given a hint. Who owns a online facility, he should be a non-resident. So the non-resident condition still remains, and should be levied for any e-commerce supply or services he provides to a resident in India. So if the e-commerce operator provides any e-commerce supply or services, the equalization levy rate is 2%. This is not 6%, mind you. This is only 2%. So please note the difference. Online services 6%. For e-commerce operators, non-resident e-commerce operators who are doing or providing or facilitating e-commerce supply or services to resident Indians or to people in India, then any consideration paid to the e-commerce operator, 2% equalization levy has to be charged. And this is important. This 2% will be paid by the e-commerce operator. So this is different. This is another different aspect from 1.0. What are the difference here? Obviously, the scope is different because we are talking about e-commerce operators and e-commerce supply or services. Rate is different. There it was 6%. Here it is 2%. And this is very important. Here, the discharge, the collection mechanism is not left to the resident buyer or resident service recipient. Instead, the non-resident e-commerce operator himself, the non-resident e-commerce operators have to do this. So they have put the burden on them, the non-resident e-commerce operators, to pay. So here it's like a proper payment, income tax. So now, so no withholding taxes. So they say you yourself pay 2% on the consideration you are receiving it. So this is equalization levy 2.0 in nutshell. So now let's see these three. What is the difference between the two? No, it's a lot of difference, Anjali, because in equalization levy 1.0, it is only online advertisement. Here, it's a good question actually. Here, the second kind of transaction Online advertisement is not come here. So if you are making a payment for online advertisement to a non-resident, equalization level 1.0, that is 2% will attract. But here this is a different transaction altogether. E-commerce operators. So here they are targeting a different kind of a digital players. They are targeting likes of Amazon. You imagine in the first situation, you go and buy in Amazon, that is not advertisement. So there it is for online advertisement service provider who does online advertisement related services. Any payment you make to online ad agencies, non-resident ad agencies. So that is a different scope altogether. That is only for online advertisement. You remember Right Florist making a payment to Yahoo for online advertisement. They are trying to attract, cover those kind of transaction 1.0, 2% by the resident. Here, they're trying to include expanded scope. They're trying to bring the marketplace, the likes of Amazon's, likes of Walmart. If they have a website in India, if let's assume Amazon US, Amazon India has, let's assume Amazon US has a website. In fact, I'll show you. Forgot the it's no, not TCL. I just forgot the name of this Chinese web. It's an online e-marketplace. So it's basically not. They don't have any operations in India. I forgot the name. So you can imagine a Chinese online website where you can buy and they'll ship goods to you from China. Unfortunately, I'm not able to recollect the website. But anyway, so let's come back to our this thing. So they are trying to here target. They are trying to, yes, sale of goods online, sale of services. So here they are trying to cover the e-commerce operators. Like, for example, Trivago can be one example. So we are going to look at some examples. Don't worry, I've given you some examples. So because Trivago is a travel search engine. Trivago does not have any operations in India. So Trivago Netherlands or what is the other travel? Agoda and forgot the lockdown in COVID. Alibaba is also Chinese. This famous booking.com. Yes, booking.com. So let's take Trivago. You go to trivago.com and find out flights. Now what Trivago, or let's take booking.com. So what booking.com will do is, booking.com is only a website. I'll show you. It's a good example. So what booking.com will do is, it's a website. Now, if you see, so look here, let's say Goa. So now what booking.com does is ties up with booking.com Netherlands, ties up with ITC in Goa. eBay, yes, Deepa, eBay is also there. So now what will happen? I'm Sudarshan, a normal guy, so I'll book. Now what will happen is ITC will pay certain commission to booking.com Netherlands. Now booking.com is actually a marketplace. So previously booking.com work was done by a travel agent. Today booking.com replaces it. So therefore, they are trying to cover these kind of transactions under equalization levy 2.0 e-com. So that's why it's wide and it has generated a lot of controversy. I'll tell you why it has generated. eBay, is a good example. eBay is a very good example by Deepa, because in eBay you can just like OLX Indian company. So in eBay USA, the website is registered in USA. It's a non-resident e-commerce operator. So where I can list my products. I want to sell my second-hand cycle, or I'm a cycle distributor. I'll put it, and Deepa wants to buy. Deepa in Mumbai wants to buy. That's it. I'm from Chennai. Deepa from Bombay, and then Deepa pays money through eBay. So eBay will collect the money, cycle money, and then they will retain their commission and give the balance to me, the consideration. So now they are trying to attract these kind of transaction. That portion which eBay retains, they say you have to pay tax, because who's your market? Your market is India. So these are the non-resident e-commerce operators they are targeting for any e-commerce supply or services. Exactly, Anjali. So EL 1.0 is online advertisement. That is for online advertisement. And equalization levy 2.0 is for e-commerce supply or services by non-resident e-commerce operator. Now, who is a non-resident e-commerce? So what are the, so who is a non-resident e-commerce operator? Look, so this is a question you all had. A non-resident e-commerce operator is a person who owns, operates, very wide definition, who owns, operates or manages digital or electronic facility or platform for electronic commerce. So very wide definition. Again, electronic commerce is not defined under the income tax, but is defined in GST, defined in some other regulations. So electronic commerce, as you know, any sale or goods that happens digitally. So these are some of the leading marketplace players: Amazon, Alibaba from China, Walmart, eBay, SOUXQ.com, Etsy. So these are non-residents. We are only targeting non-residents. We're not worried about Flipkarts, Shop Clues, or Snapdeal likes of it, because they're all Indian e-commerce operators. So therefore, you can always, their commission will get taxed in India. So we are only concerned about non-resident. This is very important. Non-resident e-commerce operators. So Booking.com will also come, because they're based out of Netherlands. They are also, because they operate, manage digital or electronic facility for electronic commerce. So this is a e-commerce operator. Now they should, under the definition, if you recollect, they should do e-commerce supply or services. Now what is e-commerce supply or services? E-commerce supply or services is also mentioned, that is online sale of goods owned by the e-commerce operator. So for example, if the non-resident e-commerce operator owns any goods, that goods belongs to him and he sells them, it will come here. Online provision of services, like what Booking.com we saw, it's only a service, they're not selling goods, so that is also attracted. Online sale of goods or provision of services are both facilitated, so I need not even own the goods, like an Amazon marketplace, like OLX. OLX does not own any of the goods, it's just a pure marketplace. So let's assume OLX is a non-resident e-commerce operators. So they will also come under, because facilitating, they are facilitating. So I need not even own. The first two says the e-commerce operator himself owns. For example, today, if you see a lot of the brands, due to COVID, they themselves have a website. For example, lifestyle.com, Shoppers Stop, you have to go buy. And similarly, you see a lot of your favorite brands, they have their own websites. So they sell it. So they will come under e-commerce operators, because they own a platform and do a electronic commerce. So either they themselves own, or even they facilitate, or any combination of activity. So you also own. So very, very widely defined. Very widely defined. Sumit, I got your question. We will come back. the Singapore and all those there. I'll, if time permits, I will discuss that as well. But that is not relevant to. You understand the concept. Let's not get into Flipkart, and I'll tell you why they're doing it. So that's a different issue altogether. Let's discuss it after class. So now let's stick to the fundamental aspects. How do we attract? But I got your point, Sumit. Appreciate it. So now, if you're an e-commerce operator, non-resident, and you do these transactions, that is, you sell goods, you say provide services. If these goods are owned, even if they're not owned, you merely facilitate. Then it is an e-commerce supply or services. So you have to see these e-commerce operators are doing this. Then equalization levy 2.0. Who should be the buyer? Buyer should be a resident in India. This is very simple. We saw this in 1.0 also. But we are going one step further. Non-resident sale of advertisement data. Anyone using IP address in India to buy goods or services. So I will explain this through example. Let's go to better to understand whatever we have discussed through case studies. So that's a practical way to easily appreciate the provision. Now let's look at the first part. First question. I hope it's visible. Yeah. Ludo India, an Indian gaming software company, has developed a gaming app. It has approached Banana Inc., a technology company which distributes, develops, and maintains apps on its mobile platform to host its gaming app. So you can imagine whom I'm referring to. So there's a similar fruit company. So what you do? So you put it in App Store, Play Store. So Banana Inc. distributes, develops, and maintain apps on its mobile platform to host this gaming app. So now Ludo India has approached them. For this, Banana Inc. receives annual fee of 10 lakhs as developer charges or development charges. So they are giving you a platform to host your gaming app. And apart from this annual fee of 10 lakhs, they get a commission of 2.5 crores from Ludo India. So now, I don't know if you're aware, you go and download an app from App Store or Play Store. Let's assume you buy for 100 rupees or 200 rupees an app. So some percentage as commission goes to Google or Apple, depending upon Android or iOS. So if you're buying an App Store 200 rupees app or 1,000 rupees app, 30% commission goes to Apple. Apple has now reduced it. Similarly, Google also gets some commission on the app downloads because they are saying, I'm giving you a place to sell your product, so I need my commission. So this is how it normally happens. So Ludo India, has a gaming app. So that gaming app is being distributed in or showcased in iOS platform or Banana Inc.'s platform here, for which Banana Inc. charges 10 lakhs every year as a hosting fees, and then commission for any app. So here the question says, uh, 2.5 crores. Now let's try to understand whether this will come under equalization levy 2.0. Now it has to be for a non-resident e-commerce operator. Is Banana Inc. a non-resident e-commerce operator? Now let's go to e-commerce operator definition. So it is what is e-commerce? A person who owns, operates, manages digital or electronic facility or platform for electronic commerce. So here clearly Banana Inc. owns and manages a electronic facility. So he is a e-commerce operator. Now the question is it a e-commerce supply or service? Let's look at whether it is e-commerce supply or service. Online provision of services. So services are being easily, it may come under the services because they are giving you, they may say, yes, the service is provided to host the app. And since these are very widely defined, there's a very high probability that, or they will say facilitating, sorry, it will come here. Online provision of services. facilitating. So I am facilitating in sale or provision of services, sale of the app or use of service. I am facilitating it. So therefore, it will come under equalization levy. Now the question is, it has paid 2.5 crores per 10 lakhs, so 2.6 crores it has paid. Is there a threshold here? You remember there was a threshold in equalization 1.0, which was a very partly sum of 1 lakh. Here, the threshold is 2 crores. So please remember this. In equalization levy 2.0, the threshold is 2 crores. So if the transaction here, the question, had I given it for, it had this mentioned only 1.5 crores, then you could have gotten away. So here threshold is also increased. So therefore, equalization levy triggers 2% of 2.6 crores. So 2% of 2.6 crores equalization levy will come, which is, I believe, 5.2 lakhs. So 5.2 lakhs has to be remitted by Banana Inc. They have to do the process. We look at that. So therefore, please remember this why this has raised equalization levy 2.0 has raised a lot of eyebrows. It has a very wide definition. Any non-resident e-commerce operator, I will share, Kunal. Any non-resident e-commerce operator who is doing e-commerce supply of services. What is e-commerce supply of services? Any sale of goods, any provision of services, or even if you facilitate any of these, then you become a e-commerce, then you are providing e-commerce supply of services. So in this case, Banana Inc. is an e-commerce operator and they are facilitating services whereby Ludo India's app, you can download and play the Ludo game. So this is, in fact, if you read paper recently, Amazon said this equalization levy, they are going to pass it on to the customers. So which means they're like your indirect taxes. They will include it in the cost and then they will pass it on. So they are saying the burden will be shifted to the, anyways, that's a very larger debate. We will have it some other day. That is not relevant for your exam. So what this is Apple. So what Apple has mentioned is, the newspapers, you can Google it. Apple has said this equalization levy on these kind of transactions, they're going to pass it on to the developer. So now developer will have to bear the burden, who in turn will pass it on to the end customer, whoever is going to download this game. So this is equalization levy 2.0 first situation. So we are only looking at, we'll look at various other situations. I hope you're clear. I will answer some of the questions raised by Sumit. First, let's try to understand the concepts. So any non-resident e-commerce operator providing e-commerce supply or services facilitating to a resident buyer and the threshold increases. What is the threshold? 2 crores. Then in such a scenario, equalization levy of 2% will be levied on the non-resident e-commerce operator. So the non-resident e-commerce operator here have to discharge and pay the equalization levy. In equalization levy 1.0, that is for online advertisement, the onus was on the resident buyer. Here, the onus is on the non-resident service provider or non-resident provider, non-resident e-commerce operator. So we have discussed the first part. Let's look at the second question, the second variation. 2% equalization levy on 2.6 on any consideration, Sumit. So any consideration received by the non-resident e-commerce operator. So what are the consideration? 2.5 plus 10 lakhs. So on 2.6 crores, 2% equalization levy, which is what I mentioned, 5.2 lakhs. So on any consideration, the wording used in the act is any consideration. So the consideration is commission of 2.5 crores, annual fee of 10 lakhs. So works out to 2.6 crores. I hope it's clear. Now let's look at the second point. This is in slight variation. Headbook Ireland, a popular social media company, is approached by 18 plus, a Chinese mobile company, to share the data of Indian users in the age group of 15 to 40. 18 plus pays 1 lakh euros to Headbook Ireland as consideration. 18 plus does not have any operations in India. So maybe 18 plus wants to launch its mobile 18 plus. So they have approached Headbook Ireland to say, can you give me data of Indian users, the age group 15-40, you know, how much time, what are they, maybe, I don't know, I'll not get into it. So you can buy this data. Now, whether this will come under equalization levy. This is very important. You remember the presentation, I start with this slide. If you are not paying for the product, then you are the product. So this is what all your social media companies try to do. You know, get your data, analyze where, you know, what is your preference, what kind of this thing you search, and then share those data with potential people like OnePlus who are. So now coming back to the question, whether who has received, the received is a recipient should be a non-resident e-commerce operator. Now let's look whether Headbook Ireland is a popular social media company. Now, e-commerce operator, we know, a person who owns, operates, manages a digital electronic facility or platform for electronic commerce. Now, the question here is whether, let's assume he's an e-commerce operator because he owns an electronic facility. Now, provision of services may trigger because Facebook sells data. So therefore, there is a service being provided. So by the e-commerce operator, provision of services. So hence, they will come under non-resident e-commerce operator providing e-commerce supply or services. What are the services? Services is sharing of data. Now, who is the recipient? Remember, we always mention recipient should be a resident Indian, but here it is the data is being sold to a Chinese company. So therefore, the buyer is not a resident buyer. He seems to be a non-resident. So can we say equalization levy not applicable? This is where equalization levy 2.0 says, if the buyer is a non-resident and sale of Indian person's data happens, then the non-resident, then those NR to NR transactions, equalization levy will attract. We have always seen resident to non-resident transactions only, or other, that is non-resident providing service to a resident. But here, non-resident to non-resident, but if the services pertains to Indian personal data, data of a person resident in India, then they are saying equalization levy is applicable. Sharing of data is illegal. Sumit Jain says sharing of data is illegal. Sumit, we do not have any data privacy in India as on date. Again, there's a data protection rules are going on, and if you provide your consent, there is every time you click, I accept my terms, conditions, every time you sign up for Facebook, every time you sign up for WhatsApp, go to the last page, click, you don't read any of it, you provide your consent to sell data. So once you have decided to sell, the data is not illegal. So you have given your consent to sell. So this is what the slide says. If you are not paying, you are the product. So they're only trying to sell you. So get all the data free from you and sell this, because you yourself have provided consent. Tomorrow in a court, you cannot come back and say, they have given my data. There's another very interesting Netflix documentary called Connections. You can look at it. It's about a French girl whose data will be sold by Tinder app, and I believe the data runs to some 8,000 pages or something. All the details. Anyway, that's a different topic. We can debate it. Nice to talk, but not here. But anyway, since Sumit raised this illegal, it is not at all illegal. There is no way. But data protection regulation rules are now still under draft stages. How to protect data? India is working on it, but as of now, we do not have any protection of data. We share everything. We keep liking. We share everything. So all these things people are using it, and which is what your social media. That's how they make money. So therefore, once they sell your data, so they say data. This is the first time. India is the first country to tax data. No other country till date has this thing. So for this 1 lakh consideration paid by Headbook Ireland to 18 plus China, for this 1 lakh euros converted into INR, Headbook Ireland has to pay 2% equalization levy. 2% Headbook Ireland has to pay on 1 lakh euros. To convert INR, they have to come to India. I mean, they have to pay this money to the India code. India will say equalization levy is applicable because you are an e-commerce operator, non-resident, because you own a platform and you sell services. Provision of services is done. That is the data which belongs. Actually, once you give consent, then the data belongs to Headbook. All your data goes to Headbook because you provide your consent. So therefore, you accept all the terms and conditions. You read it, you will understand yourself. Go today, read the privacy policies of Facebook, privacy policy of Instagram, you will understand. So therefore, once you give consent, the data or your data goes to Headbook. So Headbook has those data and they sell it to potential prospects like 18 plus who was acquired. So who wants to, maybe 18 plus wants to come to India. So they are doing a market study. So they get these data. They'll accordingly try to tomorrow come out with a marketing model strategy to ensure you buy 18 plus mobile phones. So anyways, coming back. So therefore, not only resident buyer, as long as if it's a transaction between non-resident to non-resident, but the sale of data pertains to persons resident in India, then they will also be covered. This is there in your study material also. You can look at it, the new version. Sale of advertisement, which targets a sale of data collected from, this is the one. So therefore, the scope also says sale of data collected from a person who is resident in India. So therefore, they are saying the nexus is you are giving Indian person's data. So therefore, Indian government says you need to pay taxes. Equalization levy will come. Sale of data. So this is there under the equalization levy 2.0. Now, this is the second aspect to it. Now let's move on to the third question. This is again another variation. Very good question from Neil. How will Indian government have knowledge of all such agreements? Absolutely bang on. These are all practical issues. How will they come to know? That is why this data protection rules is very important. So you can go Google it, Personal Data Protection Bill, where India, one of the recommendations by Justice Sri Krishna Committee is, you would have heard about this in newspaper. It is called data localization. They also call it data sovereignty, data localization. All they are saying is any sensitive data like financial data, health related aspects, personal data, all these things, Facebook, whoever it is, all the non-resident companies, Spotify, because your Netflix has your data. So all they have, all these data they're saying, it has to be localized. That is, it has to be stored in a server in India, and then it has to be anonymized. So India is coming out with strong data protection rules. In Europe, you have a very good regulation called GDPR, General Data. It is not exceeding 2 crores, Dhanush. Okay, sorry, Dhanush. That's a good point. Okay, I kept it as No, what? How much is 1 lakh euros? 1 lakh into 80 comes to. You're right, 80 lakhs. I'm sorry. Let's keep it 10 lakh euros. Good observation, Tanush. Uh, the idea is I didn't look at the consideration. My apologies. You keep it as this. This is how chartered accountants, they keep finding mistakes. Good, but a good spot, of course. Let's keep it as 10 lakh euros. So now you keep 80 rupees, you will cross the threshold. The idea is I want to tell you that even non-resident to non-resident will come under equalization levy. Now, on that point, how India will have all these agreements? Yes, very difficult, but India is making rules. Once we have personal data protection bill, which converts into act, we may have all these data saved in Indian servers, anonymization, and you can also have a right to be forgotten. You can ask these companies to forget your data. So right to forgotten is also there. So that is part of your data protection. It is still in the build stage. Hopefully, it's supposed to be finalized this year, but by next year we should have the data protection bill. But of course, that's a different regulatory. So once that is there, India will get all those details. Now let's look at the other variation. DDLJ, a Switzerland travel agent, advertised a popular tourist destination in Switzerland, which is popular in India as famous Bollywood songs were shot there. The Swiss travel agent engaged Photogram Ireland, a popular social media app, and requested Photogram Ireland to display this ad exclusively to Indian users in India. DDLJ, the Swiss travel agent, paid, I will not make the same mistake again, 10 lakh euros. 10 lakh euros. 10 lakh euros as consideration to Photogram Ireland. Discuss the equalization levy in the hands of DDLJ. To repeat, he's a Swiss travel agent. So what it saw is, okay, there's a popular song that is shot here in Switzerland, so Indians go crazy. Now Indians like traveling, middle class, high middle class, so they all come to Europe. So it's a good way to attract them to next time they once, of course, in a non-COVID scenario. Next time I want to attract these Indians to come to Switzerland. So so let's try to target these Indians in the social media by putting these ads. Now let's try to analyze the equalization levy implications. So one hand, this is a online advertisement. Okay. So on the first look, it will say that online advertisement. But here, for online advertisement, if you remember, the person who gives the advertise, the service recipient should be a resident buyer. So in this case, the transaction is between Photogram Ireland and DDLJ Swiss. So therefore, even though it is online advertisement charges, this will not come under equalization levy 1.0 because you have to be a resident buyer. So now let's go to equalization levy 2.0 and see whether that will come. So here we are concerned about in equalization levy 2.0. Whom are we concerned? First, whether he is a non-resident e-commerce operator. Who is a non-resident e-commerce operator? Who owns a platform or a facility? So Photogram is a e-commerce operator, satisfied. Whether e-commerce supply or services. So question is, whether will this amount as a provision of services? There is a very high possibility of provision of services because Photogram provides services like displaying ad. So therefore it may come because the wordings are so interesting. Now third, here we have one more criteria now. We saw sale of advertisement data, data belonging to Indians. Now there's one more criteria. This is very important. This is what I wanted to highlight here. So here they are saying if the non-resident sells advertisement, which targets a customer who is resident in India and who accesses the advertisement in India. So now look, very interesting. So now what they are saying is equalization levy 1.0, you can get away. But if a transaction between a non-resident to non-resident, where there is an online advertisement, but that online advertisement is exclusively targeting Indian customers, targets a customer who is resident in India or a customer who accesses the advertisement through. So this is a scope under equalization levy 2.0. So therefore, here requested photogram to exclusively to display to Indian users. So therefore, targeting Indian resident. So what tomorrow happen when I go into my photogram account in Chennai, I see Swiss photo will come saying, oh, beautiful exotic location shot, famous song, Indian song. Oh, I say, oh yeah, I've seen this. So wonderful. I go immediately click, and then they say 3 nights, 4 days package, stay here, and all those things. Indian food, Jain food available, so on and so forth. So therefore, so this is specifically targeting Indian customers. So tomorrow, next trip, okay, I will try to go to this particular location in Swiss because they have good package, Jain food is available, something etc. Cater to India. So therefore, this will come under equalization levy 2.0. So equalization levy 1.0 online advertisement should be for resident buyers. That is, a resident buyer should avail the services. Here, non-resident to non-resident, online advertisement, but if it is targeting Indian customers, like in this question, equalization levy 2.0 will come. So therefore, on this 10 lakh euros, same 2% will have to be discharged. Now, how will India come to know that the arrangement between DDLJ, Switzerland, and photogram? I honestly don't have an answer, but that's what the provision says. So these are the 3 variants. I've tried to show you as to how equalization levy is attracted. So now let's try to solve one last problem in equalization levy, which is a combination of whatever we have discussed. So this will hopefully establish or strengthens your understanding. The question is, XYZ company, a non-resident entity, this is very straightforward, based in Singapore, owns and operates an electronic facility. So you don't worry, in exam, they'll give you all these questions. They'll give you this, owns, operates an electronic facility. So XYZ is a non-resident e-commerce operator because it affects online sale of goods manufactured by it. So he is a non-resident e-commerce operator and he sells e-commerce supply of goods because he is selling goods to a person resident in India, 158 lakhs. So non-resident e-commerce operator, e-commerce supply of services, and it should be for a person resident in India. So therefore, all these 3 conditions are satisfied. Amount works out to 158 lakhs. Now let's look at the next part to it. Receipt from sale of goods to person not resident in India. So this is sale to non-residents. Out of the said sum, so 96 lakhs sold to non-resident in India. So they are not resident buyers. But the question says, out of this sum, 57 lakhs relates to receipts from persons using IP address located in India. So this is also covered. So therefore, 158 lakhs, standalone 2 crores, less than 2 crores, so threshold not satisfied. 158, but we also have another information, 96 lakhs. So 158 lakhs plus 96 lakhs works out to 2 point, I believe, 54 crores, 2.54 crores. But hang on, you cannot take the entire 96 lakhs because 57 lakhs pertains to using internal protocol. So you have to take only 57 lakhs. So 1.58 lakhs plus 57 lakhs. So we'll come to 2.14 crores. So 2.1 crores. So therefore threshold crosses. If you, I hope you all got it. So non-resident e-commerce operator satisfied. And he should supply e-commerce supply of goods or services. That is also satisfied because he's selling goods. To person resident in India, squarely covered. Person resident in India is covered. Any person, the buyer is a resident in India, covered. It also says, the next part to that question says, persons not resident in India. So they are non-resident buyers. So you will tend to exclude this 96 lakhs. But look at this question. It also said INR 57 lakhs in this 96 lakhs. Even though this is sold to non-residents, it is from persons using IP address located in India. So therefore, this is from an IP address located in India that is included here. Sale of data collected or sales to a person through using the internal protocol address located in India. So if you sell anything through an internet protocol, so even anyone using IP address in India to buy goods or services. So I may be outside India, but if I use an IP address in India to buy goods or services, I will also be included. So this is very expanded. This has raised a lot of controversies because equalization levy 1.0 was very clear. The buyer should be resident. Here they have gone one step. If it is non-resident buyer, but it pertains to sale of data in India of Indian personnel, and if it is through an IP address located in India, then they will also come under equalization levy 2.0. I'll give you one final example as to why this is very controversial, why it has raised a lot of eyebrows. Let's take, I want to go to Austria, Vienna. So what I do is, I'm planning to go in January to Vienna for some whatever purpose, for professional or for leisure. So what I do here is, I saw this, I want to stay in Hyatt. So I go to Hyatt website, I found that there's a Park Hyatt in Vienna. So what I can do is, I can book directly. I'm now doing this live. This is live. I'm in Chennai. I want to go to Vienna, Austria in January. I want to stay here, Park Hyatt. So I go to the website, hyatt.com. I can book the rooms here. So I can just go here. There's a member rate, standard rate, 450 euros. I can select and book the room, pay through PayPal or credit card. Booking is done. Now, will this come under, will Hyatt Vienna, Park Hyatt Austria, will they have to pay equalization levy? It looks like it has to be, because what is the condition? It should be an e-commerce operator. Who's an e-commerce operator? E-commerce operator is a person who owns or operates a facility. Here, this is a website, a digital facility they are owning, and they should sell. They are selling, or you can call it services. Hotel room can be a sale, or goods or services, however you want to put it, you put it. And who is the buyer? I am a buyer, resident buyer in India, or I'm using IP address. This IP address is located from India. So like me, you all do this booking. How many people? So we are asking Park Hyatt Austria to come and pay 2.0 to say 2% on this consideration, whatever they have received from India. So this is very onerous, stringent, but then that is how the provisions look like. So this is equalization levy 2.0. Non-resident e-commerce operator selling goods owned by it, providing services owned by it, or selling goods, providing services facilitated by it to a resident in India, to a non-resident. If the data is sold, remember the example of a head book and 18 plus. And then similarly, even though the buyer may be non-resident, but if it's through an IP address located in India, even then it will attract. So that's why it is very wide definition. One final, very, very important aspect with which I will close today's session. You remember section 10, clause 50 in Equalization 1.0. I mentioned it that once you come under equalization levy, you are exempt under Income Tax Act. You don't need to worry. But for Equalization Levy 2.0, very surprisingly, 1050 exemption is not available for assessment year 21-22. They are only allowing from assessment year 22-23. I repeat, Equalization Levy 1.0, once Equalization Levy comes, income tax won't come. 10 clause 50. Even for assessment year 21-22, you can take this. But for the second transaction, that is non-resident e-commerce operator, if equalization is attracted, Income Tax Act will also attract. 1050 is not available for assessment year 21-22. Why? Don't know. It is available. So on the first aspect, you will expect that is this is this an intentional, or is it by mistake they have missed out assessment year 2022? Unfortunately, no, it appears to be intentional. Government is trying to signal a strong statement to US companies or foreign companies, e-commerce, and telling them, come to the discussion table. Let's try to find a solution as to how to tax these digital companies. Because we started this discussion in 2013, we are in 2020, we still do not have any discussion because countries are avoiding, especially US is avoiding, because their companies will get will come under taxation. So, and US does not want to give away its tax revenues. So therefore, India is trying to send political messages, powerful messages. So now for assessment year 21-22, not only equalization levy, assessing officer can also invoke provisions under Income Tax Act. So you need to remember that this is exclusively for assessment year 2021-22. So with this, I will stop. So I'll just give a quick recap of equalization, the second leg of equalization levy, which is for non-resident e-commerce operator, providing e-commerce supply or services of goods, services, and then if it is for resident buyers, equalization levy at 2% will come. If it is non-resident buyer, but the sale pertains to Indian person's data, equalization will come. Similarly, if it is a non-resident buyer, but if the transaction is through an IP address located in India, like what you saw in Hyatt, it is through an IP address located in India and to a resident buyer also, that will also come. Very wide. But anyway, from an exam perspective, you can watch out for question like this. This is how they will try to test you. And more importantly, under equalization levy 2.0 for non-resident e-commerce operators, section 10 clause 50 exemption is not available for assessment year 2021-22. From assessment year 22-23 it is available. Equalization levy 1.0, please don't worry, 1050 is available for all the assessment years. Only for equalization levy 2.0, that is for non-resident e-commerce operators, equalization levy and Income Tax Act will both can function together for assessment year 2021-22. With this, I'll stop. I think the equalization levy 2.0 would have gone heavy. What I would recommend is just digest this over the weekend. But the concept is pretty simple. They only want to target Indian related, anything where a foreign company, non-resident basically, who are making money from India either through selling goods or through selling data. As I mentioned to you, Facebook. So this is a new age concept, sale of data, and also wherever you are targeting Indian personnel, non-resident, but you are targeting Indian consumers. That also they want to bring under equalization levy. This is the law. How it will practically work, how is it, we'll only know in the future. But for assessment year 2021-22, this is the law. So I'm done with it today. So what I will do is I will just take few questions. So thank you very much. If you have any questions in equalization levy, please do let me know. In the next class on Tuesday, I will revisit this again or answer your questions. But I'll just take up few questions for those who have raised. Vignesh, sir, this transaction in 2.0 doesn't seem to be income that arises or deemed to occur in India. Data 18 phone gets unless it launches its product. How can that be taken? Very good question, Vignesh. That's why you're deemed to accrue arise in India, accrue arise in India, and all those things are section 9 concepts. Now, specifically, since it's a good question you have raised, this has been now addressed in section 9. You can look at explanation 3 of 9 clause 1, where they have specifically included this part, whereby this is termed as a deemed to accrue or arise in India. So go to section 9. I'm just taking the act for you. I can show you. So government is smart. Don't worry. They'll know people will come with these questions. So you can look at explanation 3A 9 clause 1 explanation 3A 911 explanation 3A. So explanation 3 has been amended specifically to say they are deeming income. So I hope this answers Vignesh's question. Neil. Okay, I've discussed those questions. How to track any it is not possible. Absolutely, Sumit. I really don't know how they are going to track. But again, as I mentioned to you, it looks more like a political statement by India to arrive at a solution. See, because equalization levy, when India introduced the equalization levy 1.0 in 2016, seeing India, almost 15 or other countries have introduced. But they call it digital services tax. Even European countries have introduced. So India has actually set the ball rolling. So this way, by countries unilaterally imposing taxes, brings US, the major tech company. US and China are the major tech companies. So they come into the discussion and they'll try to arrive at a solution. Who will tax what? Where is a PE? So the idea is basically, come, let's discuss. We need to revisit our tax treaties because we are having old archaic concept. Now let's try to bring in new age concepts, because all your US company, multinational company, especially these tech companies, are avoiding tax in India by doing this. Imagine Facebook selling all our data to some non-residents and they don't pay any tax in India. So India says, I want to monetize it. You are selling Indian person's data, so pay. So that is why equalization maybe 2.0. But practically, I totally understand. Yes. Okay. 2% Amazon needs to pay on bill value. Kindly confirm. I'm not getting into the business mechanics, Sandeep. I think we can discuss this offline. So this has nothing to do with equalization. Okay, I think I've answered the other question. So 1.0 is straightforward, online advertisement services, 6%. 2.0 is non-resident e-commerce operators doing e-commerce supply or services. The rate is at 2%. And here the onus is on the discharge is on the non-resident e-commerce operator. So these are the subtle variations. We'll try to upload these questions as well. Do practice. So pretty straightforward. Again, 6 to 8 marks on equalization levy. Another low-hanging fruit. I foresee this coming in exam, especially the 2.0, because it's an amendment which has caught the storm, meaning it has raised a lot of controversies I see a lot of questions being raised by you all, which all the more shows that how you yourself see there are a lot of loopholes, very vague, widely worded. This is therefore, in all likelihood, examiner might test you on equalization levy 2.0. If 2.0 not applied in assessment year 2021-20, see 2.0 is applicable only from assessment year 2021-22. That is financial year 2020-21. So this was introduced in Finance Act 20. So therefore, it is applicable only from assessment year 21-22. So 2.0 was not there last year. So I don't know. Thank you, sir. If 2.0 not applied in assessment 21, this means this not okay. So if 2.0 not applied in 21-20, see 2.0 was never there in assessment year 2021, Vignesh. So nobody was paying taxes. All these non-resident companies says, where is section 9? Income does not deem to occur in India. Why should I pay tax in India? I'm selling data and that is happening between two non-residents. And where is the provision for you to tax in income tax? Even assuming you bring all these under income tax, they were taking treaty benefit. So now that is why equalization levy is coming under Finance Act. They're saying to Indian government says to hell with tax treaties. This is a separate. You are doing economic transaction in India, pay tax in India. So it does. So that is why treaty is not available. Treaty benefit cannot be availed. So very controversial area. So I think I will stop with this. I wish you all a very good weekend. So tomorrow, when you get some time, please go through the provisions. So that way, I think you'll have a firm grip because we have solved all the variations today as exercise. So this way, you don't need to spend time on these low-hanging fruits. You can focus on some other complex provisions. So thank you very much. Good night. Have a safe weekend. Have a good weekend. Have a good Sunday rather. Thank you.